Most people spend their entire careers trying to get a raise, work harder, get promoted, negotiate a little, maybe land that six-figure salary, and then feel like they finally made it. And look, on paper it sounds great, but here's the thing nobody tells you when you're sitting in that HR office signing your offer letter. The moment you become a W-2 employee, you walk straight into the most taxed position in the entire economy. Not your boss, not the company, you. And the painful part is, it happens before you ever see a single rupee or dollar of what you earned. See, when you're an employee, the government gets paid first, always, before your direct deposit hits, before you buy groceries, before you do anything with that money, a chunk of it is already gone. We're talking federal income tax, state income tax, Social Security, Medicare, and in some cases, local taxes stacked right on top of each other. By the time that paycheck lands in your account, you might already be down 30, 35, sometimes closer to 40% depending on where you live and what bracket you're in. And here's the part that really stings. You had absolutely no say in any of it. No choices, no strategies, no moves to make. The system just takes it automatically because that's how W-2 income is designed to work. Now, compare that to your boss, or better yet, compare it to the business owner down the street who's pulling in the exact same $200,000 a year that you are, because this is where things start to get uncomfortable. That business owner doesn't pay taxes the same way you do, not even close. While you're getting taxed on every dollar you earn before you spend a single one, the business owner does something completely different. They spend first, then they get taxed on whatever's left. Think about what that actually means. Their office space, deducted. Their car used for business, deducted. Their laptop, their phone, their software subscriptions, their business meals, their travel, their health insurance, sometimes even their home office. All of it comes off the top before the IRS ever calculates what they owe. So let's walk through the numbers side by side, because this is where it really clicks. Imagine two people. Both make $200,000 this year. Person A is a salaried employee, a W-2 worker. Person B is a business owner. Same income, same country, same tax year. Person A gets their $200,000, and before they can blink, federal income tax takes maybe 32% on the higher portion of that income. Social Security and Medicare take another 7.65% from them personally, and their employer actually matches that. So the true cost of their labor is even higher than their salary suggests, but they never see that part. When everything shakes out, Person A might take home somewhere around $130,000 to $140,000. They had no deductions, no strategy, no flexibility. The government just ran the numbers and sent them a bill they could never negotiate. Now look at Person B, the business owner making the same $200,000 in revenue. Before their taxable income is even calculated, they start deducting legitimate business expenses. Maybe $30,000 goes to their office and operations, their vehicle used for business takes off another $10,000, health insurance for themselves and their family, another $15,000 to $20,000. Equipment, software, professional development, business travel, maybe another $15,000. Suddenly, their taxable income isn't $200,000 anymore. It might be $130,000, $140,000 after all those legitimate deductions, and now they pay taxes on that lower number. Same $200,000 in gross income, completely different tax bill. And that's before we even get into retirement account contributions, which business owners can use to shelter even more income from taxes in ways that employees simply cannot access at the same level. Now, some people hear this and say, well, that's not fair, the system is rigged. But here's the honest truth. The system isn't hiding any of this. It's not a secret. The tax code is actually written this way on purpose. Why? Because governments need businesses to create jobs, to take risks, to invest in equipment, to hire people, to drive the economy forward. So they built the tax code to reward business activity and to make it more expensive to simply collect a paycheck. That's not a conspiracy. That's literally written into the law. And the wealthy figured this out a long time ago. They didn't fight the system, they just learned how it actually works and positioned themselves on the right side of it. Now, here's where most people get stuck. They hear all of this and they think, okay, so I need to quit my job tomorrow and start a business and suddenly everything will be fine. And that's not what I'm saying at all, because the real insight here isn't just about employment versus business ownership. It's about understanding which type of income you're generating and what the rules are for each one. W-2 income is the most restricted and most taxed form of income in the entire tax code. There is almost nothing you can do to reduce it once you're in it. You can contribute to your 401k, maybe max out your HSA if your employer offers it, and that's largely where your options end. But the moment you start generating any form of business income, even a side business, even freelancing, even consulting on the weekends, you open up a completely different set of doors. Now you can deduct expenses against that income. Now you can structure things differently. Now you start playing by a different set of rules. And here's the thing most people never realize. You don't have to go all in to start benefiting. Even a legitimate side business running alongside your regular job gives you access to deductions you'd never see as a pure W-2 employee. Your home office, if you use it exclusively for business, your equipment, your education related to that business, portions of your phone and internet, professional services, business-related travel, these are real deductions that real people use legally every single day. The wealthy didn't stumble into this knowledge accidentally. They grew up around it, or they sought it out deliberately. And the gap between someone who understands this and someone who doesn't isn't just a knowledge gap. It's a wealth gap that compounds every single year. Because every year you overpay in taxes is a year that money didn't go into investments, didn't compound, didn't grow, didn't build anything. It just disappeared. And the brutal math of compounding means that an extra $20,000 or $30,000 a year redirected from taxes into appreciating assets over 20 or 30 years doesn't just add up, it multiplies. So the real question isn't whether this is fair or unfair. The real question is which side of the tax code are you going to be on? Because the code isn't changing for you. It's been this way for decades, and it will stay this way long after this conversation is over. The people who figure this out early, who stop chasing the raise and start understanding the rules, those are the ones who look up 20 years from now and realize they didn't just earn more than everyone around them, they kept more. And keeping more, it turns out, is the whole game.